Welcome to the Federal Retirement Podcast. My name is David Rates from Benchmark Financial Group, and every month we discuss important topics regarding the retirement planning process for federal employees. This Lunch and Learn series is an interactive discussion where individuals can ask questions. To join these discussions live, you may register by joining our email list at bfgkc.com. We also provide in-person retirement planning and benefit education to federal employees. To learn more about these seminars or to schedule a seminar at your federal agency, go to our website at bfgkc.com and click on seminars. Additionally, if you're looking for assistance to get your retirement on the right track, set up an appointment with us today. You can schedule an appointment online by visiting our website at bfgkc.com or email me at david.rates@bfgkc.com. The contact information is also listed in the description. By setting up a complimentary consultation, we can review your financial situation and develop a plan to meet your financial goals. We hope you enjoyed this topic and hope to connect with you soon.
Welcome to the webinar, Maximizing Your Federal Benefits with a Federally Focused Advisor. My name's Gary Rates. I'm the founder of Benchmark Financial Group. Benchmark is a federally focused advisory group that understands that federal employees operate under a very structured retirement system that includes unique benefits as well. At Benchmark, we also carry special certifications such as IAR, or Investment Advisor Representative, which means we are legally obligated to act in your best interest. And we also have the FRC credentials, which stand for Federal Retirement Consultants, who demonstrate expertise in both federal benefits and retirement benefits. With new administrative policies evolving rapidly, creating and reviewing your retirement plans often is extremely important. Our goal is to help provide you with a personalized plan tailored just to you. So last, I would like to introduce our speaker today, David Rates. David is the president of Benchmark Financial Group. David?
Well, thanks for tuning in to this month's call, everyone. Like we said a second ago, the topic of the day today is maximizing your benefits with Fed-focused advisor. So feel free to chime in with any questions that come to mind. So a little bit of background on who we are and what we do. We're a comprehensive financial services firm. So we spend a lot of time working with folks on growth and income strategies with investment accounts, which are usually traditional IRAs, Roth IRAs, or oftentimes just after-tax investment accounts. But inevitably, sometimes life insurance comes into the conversation, or long-term care insurance comes into the conversation. So we have those components to our practice as well. Like we said a second ago, we are technically defined as investment advisor representatives, which just means that we're licensed to charge a fee for investment advice. We are fiduciaries, which means that we're obligated to put our client's best interests ahead of our own, which in our world, if you're not putting your client's best interests ahead of your own, it's not a recipe for longevity. So we do carry an industry designation called an FRC, Federal Retirement Consultant designation. And in a nutshell, we've been doing it for a while now, so we've seen a lot of different scenarios over the years. We haven't seen everything, but it certainly helps to have a bank of reference points to draw from going forward. So a little bit about the FRC designation. It's a professionally listed designation in FINRA. It's specifically for financial professionals who have a specialized education in the complexities of federal benefits. In a nutshell, you take a test with the FRC folks that just demonstrates that you have enough knowledge of the federal benefits program. And then there's a continuing education component as well. Every year there's subtle changes to the overall benefits package. So make sure we're up to date on all the changes that take place from one year to the next. All righty, so a little bit about what we do in terms of income planning. Income planning is a very important piece of the pie. Inevitably, we have a lot of conversations with folks about, obviously, FERS pension is a big piece of the pie. There's a lot of curiosity about the amount. We spend a lot of time working with folks on mapping out the survivor benefit options that are best for them. It usually works out where you got this gross pension amount, and then people are weighing the pros and cons of the standard default survivor option is a 50% surviving spouse benefit from Uncle Sam. But sometimes it makes sense for people to opt for the partial survivor. So the partial survivor benefit is a 25% surviving spouse income stream on that FERS pension. So it just kind of depends on everybody's individual life situation. Like I said, the standard default is the maximum 50% survivor option. But if you have a scenario where you get like two federal employees that are married couples, sometimes they opt for doing the life only option or taking the partial. So again, pension amount, mapping out the survivor income streams, knowing what those are going to cost while you're a retiree, those are all important pieces of the pie. Inevitably, there's also quite a bit of conversation that centers around what folks do with the federal employee group life insurance. Federal employee group life insurance, they give you a ton of coverage and it costs next to nothing when you're earlier on in the age spectrum. But as you start to add years of service over time, you hit certain milestones where it starts to become pretty pricey. So usually folks, if they have FEGLI, they're hanging on to basic, which is your salary rounded up to the next 1,000 plus 2,000, and then option A. Those two options aren't necessarily breaking the bank in terms of costs. The multiples of salary that really get you. So there's a lot of conversation about, so there's a price for FEGLI while you're working, and then there's another price, a separate price, a little bit higher price to hang on to the full boat of FEGLI as a retiree. So folks they usually want to get an idea of what that cost is going to look like. So most of the time in retirement, people hang on to basic and option A and take what's called a 75% reduction on FEGLI. But third piece of the pie, the FERS supplement or Social Security, we spend a lot of time with folks mapping out what those payments are going to look like. Inevitably, the timing of benefits is an important component. If you're in a spot where you can retire with an unreduced FERS pension and get that supplemental payment, folks are always curious about that payment amount, how long it lasts relative to when you can turn on Social Security. So like if you're in that boat where you can retire at 60 with 20 or minimum retirement age with 30 years of service, usually you're in a zone where they're going to pay you that FERS supplement from the time you retire until 62. And then once 62 hits, that FERS supplement automatically stops and you're eligible to turn on income from Social Security. But there's a lot of conversation that centers around the earnings limitation with the FERS supplement and Social Security. So in a nutshell, with that piece of things, you can't go make an unlimited amount of money when you're getting paid the FERS supplement. So people are curious about how much money they can make on a monthly basis relative to all the other income sources that they have. And then TSP, we spend a lot of time with folks mapping out income strategies. But in addition to figuring out, you've been saving this money for years and years and years, how do you turn it into income? You also have to focus on a growth strategy too. You got to focus on the long-term growth of that chunk of money as well. So in addition to those pieces of the pie, inevitably folks oftentimes have outside investment accounts as well. So outside IRAs, Roth IRAs, oftentimes folks want to incorporate those into an overall plan. So if you got TSP and then you've been saving money in a Roth IRA outside, you spend a lot of time with folks incorporating all of the pieces of the pie into a total comprehensive plan. We spend a lot of time harping on current deduction versus retirement deductions, but it's a really important piece of the pie. And it's kind of like one of the pieces of data that really gives you the green light to retire without getting buzzsawed and taking a major hit in terms of your net monthly income. So you always got to keep a focus on what am I paying for while I'm actively employed relative to the deductions that go away at the point of retirement. Sometimes when folks are looking at those estimates for retirement, it can be a little scary when you're looking at the gross numbers, but when you take into consideration all of the deductions that go away as a retiree, oftentimes the net monthly income can be a lot closer than people think it is. So one of the more important variables that we work with people on is taking a look at your net monthly income now relative to your net monthly income as a retiree. Moving on to, we got a question of the day. So 2025, there was an interesting changes to TSP contributions. Does anybody know what the changes for TSP contributions are for 2025? Well, I'm gonna enlighten you. So, all right. So TSP, obviously, you can do in terms of contributions, you can do a percent of salary or a flat amount each pay period. The normal deferral limit for everybody, just the base amount for 2025 is $23,500. That's for all ages. The regular catch-up contribution, the normal catch-up contribution for 2025 is $7,500. That's for ages, normally it's for ages 50 and up. But the unique caveat, the change for 2025 is if you are in the ages of 60 to 63. So if you're 60, 61, 62, or 63, you can contribute $11,250 as opposed to the $7,500. So if you're 60 to 63, you can contribute a little bit more than the normal amount. The quirky thing is that if you're 64 or older, the catch-up contribution amount goes back to $7,500. So if you're in that zone of 60 to 63, you got an avenue to squirrel away a little bit more money in TSP. And then this is just a link to some of the info on TSP's website. And in a nutshell, if you're born before 1961 or earlier, 7,500 is your catch-up amount. If you were born between 1962 and 1965, you're in that 11,250 zone. And if you were born between 66 and 1975, you're in that $7,500 zone as well. So this one was a part of the updates from the Secure Act that took place recently. So. All righty, moving on to advantages of partnering with a Fed-focused advisor. Income growth liquidity needs are always taken into consideration. We spend a lot of time working with folks and pinpointing, inevitably people want to know, they've been saving money in TSP and they want to have an amount of money spinning off of that chunk of savings for monthly income. But in addition to that, you also need a chunk of money that's invested in growing, but not necessarily earmarked for monthly payment, but kind of earmarked for emergencies or opportunities that crop up. And then you also need to focus on lifetime income. If you're retiring at 56, you want to be particular, or if you're retiring at 60, you want to be particular about the amount that you're withdrawing on the front end of retirement. So you don't have to worry quite so much about running out of money in your mid-80s. So it's also the longevity of your money is an important variable to take into consideration as well. So moving on so we thought it'd be worthwhile to just give you a snapshot or an example of a net monthly income comparison. So this would be a snapshot of a FERS example employee. In this scenario, gross income, 17,000 and change. Obviously, the current deductions was a noticeable number. So all of them added together on a monthly basis when you flip the leave-in earnings statement line items from biweekly to monthly. In this specific scenario, total deductions added up to about $11,000 on a monthly basis. So that put this person's net monthly income at about $6,000 a month. So how does that look relative to gross retirement income? So in this scenario, gross retirement income was made up of FERS pension, chunk of money spinning off of TSP savings, and then a FERS supplement. So those three pieces of the pie added together were about $10,500. So on a gross basis, $10,500 was the number, but when you took into consideration that the retirement deductions went from 11,000 and change down to 6,300, that put this person's net monthly income at 4,100 and change, shy of 4,200 a month. So the net monthly decrease was about $1,800, which seems like a bit of a sticker shock when you're first looking at it. But taking into consideration that while you're getting paid that supplement, you can go out and make, in 2025 numbers, $23,400 of like a salary type of income and not worry about the supplemental payment getting reduced. So that's one of the caveats about the supplement is every year there's an amount that you can go make. So for 2025, that amount on an annual basis, $23,400. But when you look at it on a monthly basis, that gives you an avenue to make $1,950 a month. So taking into consideration this person was looking at a decrease of about $1,800 a month, but knowing that they could go out and maybe work 2 or 3 days a week, making $1,950 a month, that really changed this person's outlook on retirement and sped the retirement time frame up a few years. So it's an important piece of the pie to take into consideration as well, weighing all the income streams relative to deductions that go away as a retiree and just assessing where you're at in that net income stream on a monthly basis. And then this is just a snapshot of TSP. So oftentimes folks take one TSP and they'll split it into 2 or 3 different accounts that are all earmarked to do different things at different times. And like we said a second ago, it pretty much boils down into pinpointing amounts that you want for monthly income and then having a chunk that's invested and growing, but kind of earmarked for emergency or opportunity withdrawals. So how does it work in terms of starting the process with us? We usually figure out a time to meet with you and send you a list of identifying information to gather. So the main ones on the list, leave-in earnings statement is always an important piece of the pie. So just a recent copy of the pay stub. We like to have that leave-in earnings statement because it provides the information that we need to run that net monthly income comparison. Any retirement estimates that you can track down are always an important piece of the pie. So if you've gotten any federal retirement benefits reports, if you can't get a formal estimate from HR, every year there's a FERS benefit statement that gets updated annually, and that oftentimes has a useful amount of information. And then some agencies have access to the GRB platform, which is a nice tool as well. Recent TSP statement is one on the list. Any investments that you have kind of earmarked for retirement income. So be like outside IRA, traditional IRAs, Roth IRAs, old 401ks, things like that. Any life insurance that's currently in force, it's usually a pretty good idea to have a handle on the type of coverage that you have, the face amount of the coverage, how long it lasts, and what you're paying in terms of cost. Any long-term care insurance in force as well either. So if you got any long-term care coverage that's on the books, just any identifying information that you have about that coverage would be helpful as well. Current Social Security statement, which you can get from Social Security's website. If applicable, a divorce decree is always a good one to read over again, just to make sure that everybody's on the same page about what's coming down the pipe of that. And then sometimes people want to start to incorporate spouses' benefits into a combined plan. So if you're in that boat, it's an important part as well. So first meeting, like you said, is a fact-finding meeting, information gathering and sharing. The more accurate the information is that we get from you, the more accurate we can be with the numbers that we crunch for you. Second meeting, we put together all that information into a written plan that we call version 1, and we just break down the pros and cons and give you an idea of what your decisions are for each piece of the pie. So give you an idea of what survivor benefit options are, give you a version 1 of an income strategy with TSP money, give you options on FEGLI, so you can make an informed decision on each piece of the pie. And then in subsequent meetings, it's finalizing what you want to do. With our clients, we complete the FERS retirement forms with them. And then inevitably, if it makes sense to roll money outside of TSP, there's a process that takes place of opening up and funding new accounts. And then it's a matter of reviewing investments from there and making adjustments to the plan as needed. So how about any questions, Patty?
We don't have any questions right now. David, do you have anything else?
Not right now, but thanks for tuning in again, everybody. If you think of any questions that we haven't touched on the call, feel free to give me a call, send me an email, or you can always go to our website and submit your questions via the website too. Thanks for tuning in, everybody, and hope to talk to you in the near future.